Basically, captives have been around for years. Predominantly, most people associate captives with offshore, Caymans, Guernsey, Bermuda. All the big S&P 500 countries have been using captives for a number of years. Many people don't realize, but Allstate Insurance was actually formed as a captive of Sears and Roebuck years ago. But basically, captive insurance is a way for companies and owners to kind of manage their own risk somewhat. And it's becoming more and more popular in the U.S. Right now there's about 6,000 captives that are operating worldwide, and the latest projections are estimating around 10,000 captives to be formed by 2020. They basically can choose and tailor how they want or what that risk they want to cover. There's various risks they can cover. They can cover their work comp, property and casualty. We've seen a lot of archdioceses. They've started using captives to write their E&O coverage. We've even seen health plans. They use captives to cover large risks. Pretty much, if you can imagine a coverage that a company or management needs, they can use the captive to tailor specifically to that coverage. They can use actuaries to determine their own pricing, so they have more control over their pricing. For instance, a management may work with an actuary, and the actuary may determine that management only needs $1.5 million of coverage on this risk. If they went to the commercial market, the lowest price they may be able to get to commercial, well, commercial may offer $2.5 million of coverage and nothing lower. And the price on that policy through the commercial may be 2 to 3 times what the price on that policy through the captive would be. Basically, the key benefits with a captive is that it allows management to really tailor down to risk specific to their company. Management knows their company better than an outside commercial insurer, so management can really tailor it down. There's also tax benefits in that if you form an 831B captive, or what's commonly called an enterprise risk captive, then your taxable income is only based on your investment earnings. So any other true earnings accumulates within the captive and can be distributed back to management later on at lower tax rates. And those are really some of the key benefits to using captives. And also, well, lastly, the cost. Management can really tailor down the cost using a captive versus a commercial carrier, because they can specifically identify the amount of coverage and protection that they need, whereas the commercial market may gross up the coverage and only offer, for instance, say $2 million of coverage at a much higher price, which may be more than management really needs, and management can reduce their premiums.